Welcome everyone to today's webinar titled 2025 Treasury Trends. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss the transformative trends shaping Treasury management and how to position your organization for success. Our speakers for today are Yusuf Ali, Global Pre-Sales Risk and Strategy Lead at Kyriba; Andrew Blair, Director Pre-Sales North America at Kyriba; Dory Malouf, Director Value Engineering North America at Kyriba; and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Yusuf, Andrew, Dory, and Craig, and I'll now turn the presentation over to you.
Thanks so much, Brian. Welcome, everyone. Thanks for spending some of your day, either in the evening for those from Europe, midday on the East Coast, or earlier in the morning as we head westward towards the west coast of Canada and the U.S. It's good to be here. It's good to see you, Brian, Andrew, and Dory. Brian, I'm not seeing Brian, I'm seeing Andrew, Dory, and Yusuf, so it's great to be here with you. We did this last year. It was very well received. Glad so many people are joining us on this topic. Let me cover a few things, what we're going to be discussing, and let the panelists here weigh in on some of these very important topics. What's happening into 2025? There are a number of issues with geopolitical instability. There's wars and risk management. Increased volatility or sustained volatility usually requires results. What's going to happen? What's going to change? And how do we respond to that is on topic for today. Central bank decisions, hopefully lowering rates or expectations of lowered rates, changing the cost of capital structure. What's that going to do to businesses? The overall global financial environment, GDP changes, economies in growth, or in slight recession. What's happening there? How do organizations look at that? And then the tried and true areas of focusing on optimizing working capital across the cash conversion cycle. Demands for capital and liquidity hit many organizations. There's certainly a changing technological landscape, and we'll cover items like APIs, artificial intelligence, and how things look out. We'll also look at some of the topics related to the impact of the election on key industries. We have 5 core areas. We also have a speed round. We're going to get through those items, and we have 3 polling questions. So there's quite a bit to cover. I'm going to pull this down, and I'll ask each person to introduce themselves when we begin. We're going to begin with AI and advanced analytics and risk management. So Yusuf, why don't you'll be up first, and then Andrew, maybe you can weigh in as well. The financial landscape, I think in many ways is becoming more unpredictable. Some ways it's becoming quite steady, but how can treasurers really leverage AI and advanced analytics to enhance the entire risk management process, from identifying risks to calibrating those so that they can make better strategic decisions? And what are the practical applications that are happening now, and what challenges should treasurers be aware of when they're implementing these technologies? I know that's a lot, but if you could start with just a quick introduction of your role, and then launch into it, Yusuf.
Yeah, no, thank you, Greg. So Yusuf Ali here. My role is really to help clients design a solution that can serve the need they have now, but also serve a need that they have in the future. So really, that's really the role here of the solution engineering team. Again, been in Treasury for around 25 years now. Really excited about being in Treasury exactly at this time with all the new advancement happening on AI and API. So in terms of the topic there, yes, absolutely. There is a lot of unpredictability that's been there, and I feel that it's sort of increasing. The way I view this is that there is going to be an even greater emphasis on being strategic, the treasurer required to be strategic. Also, an even higher emphasis on the treasurer to be proactive. The tools are there now to do that. And I feel that tools like AI or predictive analytics will support the treasurer in that increased requirement to, again, be strategic and also being proactive. What do I mean with that? So an example, you could use the AI models to look at the forecast. Let's say you have a forecast for the next 3 months of, let's say, 10 million euros. You can have the AI go in and look at that, and maybe depending based on factors that you may not be aware of, it can tell you, you know what, I actually think this is going to slip another 30 days, or the amount is going to change. So these are the things that you the treasurer can use to, first of all, identify patterns that they may not have been aware of, may not be monitoring, and then after that, being able to then be proactive about it. What do we do about that? How does it change our liquidity? So I think these are some of the things that the tool will help with. There are certainly also some challenges. So the challenges that I see there is there's going to be an even greater emphasis on data. These AI models are based on data. So having good data, having consistent data, having timely data is a requirement that I think will increase in the Treasury Department. So this also goes downstream. So getting the timely data from the ERP system, from the billing system, HR system. So there's going to be a pressure on getting good data, consistent data. So those are, again, some of the challenges. Plus, of course, things like, privacy and security of data, all of that. But this is sort of in short how I see that. So it's certainly great time to be in Treasury with all the new development, but also some new challenges coming out from that.
A quick follow-up on that. So on the practical side, you mentioned the forecast that's happening today, and then key focus is on data. Any things that are next in line that are becoming practical, maybe a little farther out, and then after that we'll jump over to Andrew.
Yeah, certainly. So we have looked at a few other use cases. So some of the other use cases that you can use things like generative AI. It's going to be things like investments. It could be things like hedging. So looking at that, not just looking at maybe the exchange rate, but looking at other factors. So you could use the Gen AI to maybe queue up some trades, saying, based on what I'm seeing, this is what I would suggest for you to do. And then you can then say, well, I want to adjust it. I don't want to exactly hedge that. So those are some of the other use cases. So certainly the forecasting, I can see things like FX hedging. I can see investments. So there are, I would say, if you look at your treasury policy, that is really an area where I think that you could have the Gen AI really go in and look at that and try and adjust what it sees based on that policy. So again, hedging, investment, cash flow, and so on.
Excellent. Thanks, Yusuf. Andrew, why don't you give a quick intro on your role at Kyriba?
Yep. Hey, everybody. My name is Andrew Blair. I look after the solution engineering team in North America here at Kyriba. So obviously, primary responsible for showing the product and, to kind of echo what Yusuf said earlier, just really understand kind of the needs of the space. How can technology help you, along the lines of what your issues are today, as well as going out into the future. If we transition into the topic here, I think, Craig, when you asked the question, there was a couple different things that you brought up. One of them was APIs, one of them was AI, and one of them was advanced analytics. And I think they're all actually related in a way. And you need to kind of be cohesively thinking about how they will work together. Yusuf finished off his point with the data, right? So there's no really good recommendations or suggestions from AI without your data. So I think that's the way to think through this. And once you have the data appropriately, and we'll talk more about APIs later, that's likely going to be the way that we get the data. Then you can run the artificial intelligence for some of the use cases. We can dig into that more as well. And then you have the analytics part of it, which is the application of helping you see that, visualize it, run the different types of stress tests and scenario analysis against it. So I think for me, it's AI is intended to automate in a different way that we've thought about automation previously, right? It's just to take it a little bit further than the scheduled batch file, run a rule, then to provide an output. And a lot of those, I think, use cases, when we talk about things like tagging rules or mapping rules or reconciliation rules, are really good kind of low hanging fruit as we consider what some of those things can be accomplished. to the more sophisticated things like Yusuf brought up, FX hedging and understanding what your exposures are against a policy. And there's even things around the forecast that you can incorporate, like credit risk, right? So to take into consideration what your, position is going to be at a certain period of time. And then again, based on the credit of the counterparties potentially that you're investing with or are looking at, you can take into consideration some of those things as well. So that's kind of, again, Craig, my just initial thoughts on that. I don't know if there was any, additional challenges we wanted to kind of discuss or get into around that, or if you had any follow-up on
Yeah,
this piece of it.
for you or Yusuf, as if on the practical side is what you have both been saying. One is forecasting, one is categorization, like for setting up your cash position or performing accounting, as well as forecasting. And it sounds like the next phase is identifying risks and exposures, and then doing additional analysis to spot relationships that are there. It sounds like there's like 3 levels as you were describing that. Is there anything else that we should be thinking of in this category of advanced analytics or the use of AI?
I mean, if I can start, the way I look at it is really look at, for example, your treasury policy. Look at what you need to do there. Those will be the low-hanging fruit, right? But in that, you also have sophisticated decision that needs to be made. Hedging decision. What if the exchange rate changes? So, but there's going to be also, as Andrew mentioned, very low-hanging fruit. That we need to do our cash accounting at a certain time. But you can move up into more sort of, I would say, cognitive challenge policies that you need to meet. And I feel that we're at a stage now where AI, based on what I've seen, is able to actually address a lot of the challenges, a lot of the tasks that are sort of the basis of a treasury policy. So I would say that's a good place to start if you're looking for use cases. Look at your treasury policy and look at, can we put something together in place that's going to address maybe a small part of it. You don't have to do a big bang, right? Trying to and automate everything. Maybe start with your cash sweeping, right? And that's where I think the whole agent come in, where you can have small agent that does small things, and when you sort of sum them up, suddenly you're going to have an entire cash management agent that does 10 different things that you do in cash management, risk agent. So I think the way I look at it is that breaking AI down, because what does AI in Treasury really mean, right? But for me, it means, what does Treasury do, and can we break that into smaller pieces? Maybe conceptualize that in these agents, and then really build that up, and then suddenly you now have this solution that then is AI in Treasury.
I like that. It was go ahead, Andrew.
I was just going to say, no, I think what you said, I thought you summarized it really well, Craig, actually, by saying there's tactical things and then there's more strategic things. And the things that are more strategic are relational to say, this is what we're seeing. So is there a fraud, potential abnormality because these two data points are related? And I think that one other thing, just before I close up and I'll pass it back to you, is you mentioned on the challenges. I think one of the things, even for vendors and us alike, it's a challenge can be a lot of times like the explainability of what's going on and how do we actually give confidence to what the machines are doing. And I think that hopefully will be easier over time, and there needs to be a lot of transparency involved. So I just wanted to make that call out, is when we get feedback during presentations, that will often come up as well.
Yeah, no black box. I don't know if explainability is a word, but I know exactly what
I don't either, actually. Yeah.
But it's pretty good. We can ask AI if that's the case. So great answers. Yusuf, you were talking about hey, here's the policies, and then here's what's being done. That idea of it scraping the data from written policies and looking to see if they're compliant. It seemed like you were hinting at that, which is great. We're going to shift over to optimize liquidity and working capital, section 2. Dory, we have not forgotten you. Why don't you go ahead and introduce yourself, and then I'll hand over the first set of questions to you.
Yeah, thank you. Dory Malouf. I am the director for the North America Value Engineering team. Been in Treasury my entire career, from practicing and now on this side of the fence. What my team's role is working with clients and prospects and help them identify what the current state is, what the future state needs to be, the business impact of affecting any future state, requirements and the risk of the status quo. We do benchmarking. We do value realizations on clients that have deployed different aspects of our platform. So really the cool analytical stuff, number stuff, diagrams and charts and all the fun stuff that Treasury likes to look at day in, day out. Great,
thanks. Yeah, and appreciate you revisiting on the Outlook webinar. Optimizing liquidity and working cap. I'm going to read part of the question here. Is the overall global economy is changing rapidly. There's been a lot of elections, a lot of trade issues, geopolitical risks are happening. Digital transformation is certainly occurring. What are the key factors and what strategies can companies use to optimize their liquidity and working capital, not leaving trapped cash, but using it in an efficient manner, in a transparent manner, in a way that reduces the level of risk? That's a lot of questions all in one, so have at it.
Yeah, no, one of my favorite KPIs when I was on the practicing side that I used to always measure and have on a little KPI board was the cash conversion cycle. Oftentimes we forget in Treasury how much influence and impact we can have on that. Putting aside inventory, right? Because we're not going to be able to impact inventory. We can impact how quickly we accelerate cash in the door with a factoring program. That's your sales are only as good as how quickly you convert them to cash. Those are things you can do with a factoring program at a much lower cost of capital than going to a bank, for example. We can also impact how much or how long we hold on to that cash with a supply chain financing program, and also at a lower cost of capital. We can also impact from a visibility rate. When you've accelerated cash and held on to it longer, you can impact from a visibility rate what you do with that cash and the yield you can generate for your organization on that cash. So not only are you able to impact the cash conversion cycle, but you're also impacting the bottom line for the organization when it comes to the cost of capital, which in both scenarios is lower than typically going out to the bank and trying to get a hold of the capital when you need it. Additionally, you're providing for cash flow certainty, and at the same time, you're making sure that, as you mentioned, Craig, in times of uncertainty, that you're solidifying your supplier base and vendor base that may be impacted in those times of uncertainty, giving them access to capital through your own capital without having to go to the bank as well, and making sure that that's at a lower cost for them. So there's a lot of things that you can do there, and all of those impact liquidity strategies. We actually, just off the cuff here, we do at Kyriba a liquidity performance report on my team, and we put that out semi-annually. And what we've identified is organizations that do this well, that manage their liquidity well, or put in place these types of programs that we're talking about, are on average per billion in revenue about 18.2 million more liquid. So per billion in sales, about 18.2 million more liquid when you have these types of solutions in place. So 18.2 million is quite a bit of money, right? 18.2 million on 5% interest, 3% interest, wherever we end up next year. That's impacting the bottom line for your organization.
Yeah, 1.8% of revenue for liquidity. That seems pretty healthy. Just a quick question, and I want to bring Andrew in on this as well. You could start or flip it over to Andrew. The value of something like a factoring program or some kind of secured credit is the value to organizations that it's a lower rate because it's secured, it's fully secured with that, or is it the value is now there's more information available that can be readily used to gain access to capital? How would you weigh those two? I know they're not exactly one or the other, but how would you weigh those two?
You want to take it first, Story?
Well, I think there's equally as valuable in my humble opinion. The reason I say that is because when you're looking at liquidity, it's about the ecosystem, right? It's about making sure that you have all facets of it being measured reliably, being measured timely, and making sure that they're being measured in a one-stop shop. That's how you get the biggest benefit. You can't measure all of these things and treat them equally because they're going to impact each other. Ultimately, in the end, if you're going out to one solution to look at what your factoring program is doing, and then you're going out to a different solution to try to see what your supply chain financing program is doing, or you're using something else for your dynamic discounting program and your P card program and all those things, you want to be able to see it in one location, inclusive of your debt, inclusive of your risk. So all of them, you have to treat them as equal because all of them intertwine ultimately in the end to impact your liquidity profile and what's happening to your bottom line tied to those KPIs.
Yeah. I think where I was gonna go with that is again where you just kind of explained it, Dory, is the centralization of all of the components that do touch the liquidity, which will obviously incorporate the working capital. So it's just like the data strategy with AI. You have to have the foundation right first. So we have to know where all of the cash is within the bank account. Is that automated, right? Do I have confidence in that? Are we reconciling that on a regular basis? As we do that, then we start to build to some of those other levers that do affect the liquidity, right? So again, whether it be the components of your debt or borrowing base or investment strategies, and that's when I think you can start to automate some of those things on the actual working capital side. Dory mentioned a couple things on the payable side to potentially, obtain fees from your suppliers via dynamic discounting or just maybe streamline the program via traditional SCF. And then on the receivable side, again, is it goes back in, for me at least, it goes back into the efficiency of that centralization. Or when you're looking at your liquidity, do you have the full visibility of all of your invoices in one place, the impact of what your deal parameters and negotiations are for each one of those vendors? So when you do go to make those decisions to, again, pay down debt or sell receivables early, whatever that may be, you have all of it again in one place with the confidence to be able to kind of execute on that strategy. It's for me again, as having these conversations with companies, it's just most of this time it's disparate. There's data points kind of sitting all over the business, and that's what makes it challenging.
Yeah, interesting. When we get to talking about APIs in our next section, we have a couple things in between that. It's interesting is about the openness of systems as well, right? There's the centralized system. There's certain inherent efficiencies, but there's also the ability to connect other things because, is everything in the ERP? Is everything in the TMS or the risk system? Is everything in admin systems or in the overall data lake? There's an expansive view of that. So I'll be interested to hear some thoughts on that because as things change, there's how do we connect and see everything? But the efficiency and the visibility seem to be huge players there. With that, we're going to shift to our first poll question that's going to pop up on the screen. Everybody who's online, go ahead and select which one makes sense. How likely are you to integrate AI and advanced analytics into your treasury operations by the end of 2025, right? So very likely, somewhat likely, unlikely, undecided. If you've already done some integration there, put very likely. We didn't put an option of, we're already doing it. So go ahead and put that in there, hit submit. And then I have a challenge after you've done that. In the chat box, once you've done that, go ahead and you can type in the word Kyriba or Kyriba 2025 in the chat box. If we get, let's just say 200 people typing Kyriba 2025 or Kyriba in the chat box, we will send you the results of all three poll questions when they come up. So, and we'll make Brian keep counting those things. So it's excellent. I love it when people put it in the question and answer box too. We'll just take a moment. And then on deck, Yusuf, you're queued up to be the primary respondent when we talk about real-time payments and API. So Don't go away. All right. Number one, somewhat likely and very likely, 20%, 52%, unlikely, undecided, and unsure. So just over half are looking at doing that. Really, really interesting to see that. It's growing very quickly. We'll just pop that off the screen for now. It's one of those few areas where the ability to do that is driven heavily by the support of vendors who build that into the system. And so you can use that without necessarily having to create all of the data sources and train the systems on your own. You can leverage providers who do that for you. So thanks for taking that poll question. And we're going to move on to the impact of real-time payments and APIs. Yusuf, you're up first. So, real-time payments, this immediacy certainly has use cases. It's not been as urgent as before across the board, but there's certainly use cases that it matters. Nothing's getting slower, but real-time payments and APIs are transforming the cash management space in incredible ways, and they're disrupting some of the traditional treasury operations. Fast, immediate availability to your cash balances or status on payments. What benefits can and should treasurers expect to see in terms of efficiency, transparency, and risk mitigation? Right, we already talked about transparency and efficiency on the capital side, but just those three dimensions, Yusuf, if you'd start us off on that.
Yeah, no, absolutely. And this ties in nicely with our first topic here regarding being proactive. So I think what the real-time payment has allowed the Treasury Department to do is to be quicker, right? So you can respond quicker. You see something, you can respond quicker. We've been through a few bank crises and so on. I think what the real-time payment would allow us to do is respond quicker to some of these unpredictable events that are happening. But I would say before then there was this lag, right, between when you do something and it actually happens at the bank, but that lag has sort of disappeared. So again, being more nimble, being quicker, being able to respond quicker. Right, you're proactive. You're being notified about something's going on, whether it's AI or whether it's team members. You can now respond to that quicker. What that does in terms of the challenges, again, it challenges the Treasury Department to not be the bottleneck, right? So you cannot be walking around trying to now get this payment assigned manually by walking around from office to office, right? So it certainly puts challenges in terms of being efficient within Treasury. And also puts challenges downstream again to the system connecting to it. So you can execute something real time, but you need to be able to also have that being streamlined throughout. So it's a little bit of the same story with AI and the data. It is now the technology is there. We need to actually look all the way downstream, making sure that everything flows through efficiently so real time can really be real time. So again, reducing the lag and being able to respond quicker. And even from a risk mitigation, the fact that you can see money coming into the bank account quicker maybe allows you to not tap into that credit facility, right? Because you can see that immediately. So there are definitely a lot of gains here, risk mitigation, being able to see money actually was sent out or wasn't sent out, or being able to move money quicker, right? You see an event, you can move money quicker. But again, the challenges are, again, the downstream, right? Making sure that Treasury is not the bottleneck. So that really sums it up. I would say, API is so fundamental for all of this, what we do, right? Andrew mentioned getting data back and forth. Well, API is the one that takes care of that, right? So API is key and is really the enabler of even what we see on the AI part, right? Getting data in, moving data back and forth, and also what we talked about, future use cases for AI, that also requires the API being able to then act on those, right? If it's hedging, if it's investment. So it's really I would say the foundation, the data and the API are really some of the building blocks, really making AI and predictive analytics do what it does right now.
Yeah, thanks for that. I know we want to get Dory to weigh in too. Andrew, you're up on this as well. What else do you see? Anything you want to emphasize or add to what Yusuf mentioned?
I would just say that I think, if we separate real-time payments and APIs just for 1 second, even though they're kind of the same vein, the benefit of real-time payments is maybe somewhat obvious. It's to get the money out quicker and then obviously reconcile the cash quicker. So the whole treasury loop and life cycle should be done obviously fast. We talked a little bit about the APIs previously, and again, the one thing I just want to maybe call out because Craig, you prompted this on when we finished in the last section, is that the API is just it's a better, more efficient way of communicating the data than has traditionally been available. Meaning, these APIs with the banks or with your ERPs, they are certified embedded connectors that are that are meant to work kind of on day one as they're built versus the means of scheduling a file to go out to transform that file to re-ingest it. There's just a lot more breakpoints that are able to be mitigated, and then you're not again waiting for the next. I think it's 4 minutes and 30 seconds is the next time that file is going to run. It just provides that on-demand treasury, if you will, and it goes beyond payments even, right? Again, it goes back to the journal entries and the cash reconciliation. So that would be my only kind of addition to what Yusuf said. I think he kind of hit all the top talking points.
Yeah, on demand or on occurrence, right? When it happens, it occurs. There's none of this batch. Let's wait for the night. Let's wait for, whatever, the world of analog and nighttime.
Yeah, exactly. It takes that's the other thing too. It kind of takes, not that it takes completely the time zone issue out of it, but in a way it does, right? You're not focused on a specific calendar setting in a database. And those are all obviously things that you'd be familiar with if you did implementations and things like that. But I think it's a good call out.
Good point. So Dory, you want to correct these two?
No, absolutely not correct. They are the experts. I just want to say when it comes to real-time payments in particular, not everybody needs that, and not every vertical needs that. I think where it's most applicable and most relevant is for like real estate, right? When you're trying to close on a deal and they're not going to give you the keys to that farm so you can start building on it or whatever the scenario is, that's where real-time payments is applicable. The financial sector, on the insurance side, things like that, that's where it's applicable, because not every company wants to get that cash out the door as quickly as possible, in particular when we're talking about uncertainty, right? So they're trying to make sure that, yes, they want to be on top of innovation when it comes to payments, but not everything requires that real timeness of it, in particular on the payment side. Getting access to data, APIs, 100%. You want that as real as possible. Making sure your forecast is AI embedded and reliable and timely and informed, and you're feeding external, datas and internal datas and whatever's happening in real time. Absolutely. The payment side is where I'm not 100% sold yet that everybody needs that. I think it's applicable in certain sectors, but not everybody really needs real-time payments. And that's why probably we haven't seen it take off as all these other areas like AI, as an example.
Yeah, it's certainly growing in the use of information. Everyone needs more information for a better process. Why would you pay someone 5 days early? But if you communicated what was being paid, they could have it in their system. They don't bother you. But why pay early, right? I think there's a couple really good points you make there. All right, that brings us to our second poll question, and we will move into the speed round after this one. This is select all that apply. And which strategy are currently prioritizing to optimize liquidity and working capital in the next 12 to 18 months? And if you're not doing any of those or are unsure, select unsure and hit submit. I am told we need 45 more responses, hopefully in the chat box, not all in the Q&A box. That would say Kyriba 2025, and we'll share all the results across the board. So we'll go ahead and let those populate. And the order that we're going to do, we're going to go Andrew, Dory, Yusuf. Then we're going to go Dory, Yusuf, Andrew, and then Yusuf, Andrew, Dory. We'll go in that order. So I'll just keep rotating. I'll give you the verbal guidance, but the the rules
I was gonna
for
say I didn't remember that, Craig.
Yeah.
okay, Andrew, it'll go alphabetically and just keep shifting one, so it's not always the same person answering first. I'll guide that. The key thing for the speed rounds, everyone, just so you know, and the panelists have been instructed on the rigid rules here, is you have to say the end answer first, even if you don't want to say one or the other. You have to pick an answer, and then you can provide some explanation for it. They have about 15 seconds for each one, so they got to say the answer, explain as much as they can. We'll go to the next one, and then, as possible, we'll summarize. So we have enough Kyriba 2025 in the chat boxes, so everyone will get the responses. The top two are leveraging tech to enhance forecast and liquidity management. Kyriba is going to love that. Centralizing cash management and bank relationships. Again, Kyriba is going to love that. That's a key area. And then we have digital payment methods, APIs, quite a bit of activity there, and about 1 in 5 are unsure of what they're doing. So thank you all for participating in that. So now we are on the speed round. We're going to begin with tariffs. We're going to go Andrew, Dora, Yusuf. So for tariffs between US and Canada and US and Mexico, and again, these can be your answers, right? They're not necessarily Kyriba's answers, strategic treasure. They're just our opinions. It's a fun speed round. So let's, for tariffs between the US and Canada and Mexico, will they be higher? Will there be higher or lower tariffs 6 months out in June 2025 and June 2026, 18 months out? Andrew.
And they're two separate questions?
Two time frames, 6 months and 18 months.
I'll say it will remain the same in 6 months, and they'll be higher in 18 months, I think was the secondary time frame.
It was. Any additional on that, or just that's
Only,
fine?
I mean, only I think the president-elect said, I think it was a 25% increase is what he had claimed, and so I imagine there's gonna be some attempt of kind of following through on that is my opinion.
Okay, perfect. Dory.
I think higher in 6 months, so the opposite of Andrew, and lower in 18. I think it's a negotiating tactic for other things that potentially the president-elect is trying to get out of both of those countries. But he said day one, executive action, 25% tariff that takes effect in 90 days on both countries. And if that's the case, that's 6 months from now. And then 18 months, if we get what we want out of it, I'm assuming those go away. The interesting thing is you're blowing up, USMCA by doing that, which was his law anyways. But who knows? There's probably some things behind the scenes going on that none of us are aware of.
All right, Yusuf, can you break the tie?
Yeah, I think I can. I do believe that we will be looking at higher tariffs in those two countries. And like Andrew, probably not the first 6 months, but after that, I do believe the tariff is going to be a key lever that we are going to see. That is sort of my opinion. I think that you're going to see more of that concentration of trying to keep things sort of onshore. So I would be surprised to not see the tariff going up in those two countries.
Okay, the next question will go to Dory, Yusuf, and then Andrew in that order. It's on the economy, GDP. Your view on the U.S. economy for 2025. Pick one and state your rationale. Strong growth, GDP up 2% or more. Moderate growth, GDP up between 1% and 2%. Low growth, GDP growth 0 to 1%, no growth or limited decline, 0 to 1% negative, or decline, GDP contraction by more than 1%. Dory.
I think strong growth because the Fed is cutting rates, and that's always good for impacting the economy and also impacting what companies do with their cash.
Yusuf.
I would say based on what I've seen historically, when the Fed has cut rate, that was an indication of things not being the economy not being as strong. So if I sort of have to look at what that has been in the past, my view would be it would be a slower growth.
Low or moderate?
Yeah, moderate growth.
Okay.
Yeah.
Okay. All right, Andrew, now you've got to break the tie. Well, maybe not even break the tie. There's strong growth and moderate growth.
Yeah, I'm gonna basically punt and just say moderate growth. I just, being a little bit conservative, I think things are trending. They seem, at least from, the market's perspective, to be trending in a positive direction, but there's still a lot of, there's a lot of turmoil going on. And so I'm just going to kind of stay neutral with the moderate growth.
Right. Okay, now we're going to go Yusuf, Andrew, Dory. So FX volatility, there's two parts to this question. This is very complex, of course. More or less volatility in 2025 than 2024, yes or no? And then more or less management of FX volatility. So all those on the call, are they going to manage it more by corporations next year than this year? More or less, and more or less management.
Yeah, so there's going to be, I believe there's going to be more volatility because I don't see a decrease in predictability. I see a lot of things that could just cause more volatility on FX. That's my view. In terms of all the management of that, I actually believe that there's going to be more focus on that. So I would say actually you're going to see more of both. That's what I
Okay,
expect.
more on both. Andrew?
Yes and yes as well. Again, I think there was a survey that ACT did a good paper the other day. I think it said like 78% of businesses, this was European focused, obviously, are affected by foreign exchange. So obviously, that's not going away. And I just think, yeah, I mean the visibility, the transparency, the technology that's out there to manage these things are going to become more broadly expected.
Dory, are we going to have unanimity, or are you going to put a different view out there?
Nope, more and more. I think there was also, to reference what Andrew said, different write-ups about how there was more volatility during Trump's presidency when it comes to FX than at any other time. When you have management by tweet, that's what happens, and it impacts currency all the time. And I think that's what we're going to have.
Just a correction, it's managed by X, not tweet.
Uh,
Are they still called tweets? I don't know. All right, so now we're on hybrid work, and we're going to go Andrew, Dory, Yusuf. So hybrid or remote work. Will the amount of time people are required to be in the office be greater at the end of 2025 than currently? Currently, it seems like we're hybrid, but it's about 50 to 60% on site. So more in the office, same, or more remote?
Um, I would say more actually. We do travel a decent amount for what we do, and each time we go, to visit some folks, I'm quite surprised by how many people are actually in the office. So I kind of see the trend going that
More in the
way.
office? Okay.
Yeah.
Dory?
I agree. We have to figure out a way to save the cities, and I think there's going to be some things happening to make sure that that happens. And yeah, there'll be more.
Yusuf, break
Yeah,
it.
yeah, no, I believe there's going to be more. There's been a lot of push from a lot of our corporation to get people back in. I believe that trend will continue, so it will be more. That's my personal view.
Okay, I'm going to skip the last question on payment fraud. Will there be more payment fraud increase in 2025 for purposes of time? We're going to jump into adapting to an accelerating technology pace. Thank you for all your answers, the direct answers as well as the explanation. I think that's helpful to handle that. If you like the rapid speed round, just put a note in the chat. I think it's hard for them to answer that quickly. They did a fantastic job, so thank you for doing that. So we'll start with you, Andrew, on this one, and then go to Dory afterwards. So, technology continues to reshape the Treasury function quickly, things like APIs and AI. How can corporate treasurers stay ahead of that curve? What do they need to do to use tools, to use knowledge, to train their staffs to do that? How can they do that so they can leverage the technology? Go ahead, Andrew.
Yeah, I think there's a lot to consume there. Obviously there's simple things like, fostering a culture of kind of, inclusion on these types of maybe new topics that not everybody's an expert on. There's a lot of tools that the industry, I think, is offering. This, Craig and your team, organizing a webinar like this is a good example of that, and just, ensuring that you're staying on the forefront of the things that are going on. Again, I think some of this is hard to ignore. Actually, it's a bit in your face, and so then it comes down to how do you navigate what's the reality of the situation and what's the most applicable versus where, where are we kind of sitting today. So the way I think of it, and again, when we have conversations with different companies is what does your current roadmap look like? Like what is your current tech stack? What does your current personnel kind of infrastructure look like? What are your, short-term goals as you move forward? I think all of this takes alignment across the whole business. It takes alignment with not just treasury and finance, but the technology teams and HR, so that we're, kind of shifting to the one common goal. And one of the things, Craig, I think you pointed out earlier, it's to push, push vendors and the likes of, those folks that you're working with to say, are you considering this, and this, or this is what our CTO has kind of mandated down the board here. How would you help us address something like this? Are all of those components that need to be kind of considered in the decision as you look to trend forward and not get left behind, but also not get, maybe sucked into some of those things that are more theoretical than actually practical for the immediacy.
So Dory, I'll invite you to jump in. So Andrew mentioned the tech stack, and he didn't use the word people stack, but people, and then pushing the partner environment. Your comments on adaptation to the change in technology. He also mentioned webinars like this, but I don't want to be self-serving. So
I agree with everything Andrew said, but I'll add to it a couple of things. Number one, when we talk about people, oftentimes when I'm doing presentations, whether it's at AFP or these webinars, I say that, if you look at position descriptions, right? Not a lot of them say they're looking for the next Excel wizard, right? A lot of them are saying they want familiarity with the latest technology, okay? And so don't be afraid of it. It's going to pass you by if you become afraid of it. And what's important about leveraging the latest and greatest is not all the things that we've been talking about on the webinar, but it's that optimization of human capital and being able to scale with technology rather than continuing to add bodies to support the complexities that come with growth. That's the benefit of it, right? That's the priceless, like the MasterCard commercial benefits of deploying technology, because your growth comes with complexities, and complexities require people to solve or technology to solve. Take your pick, right? No disrespect to people, but people take vacations, can get sick, can only work certain hours of the day, whereas technology is up and running no matter what, 24/7, 365. So that's the beauty of it, and don't be afraid of it. So everything Andrew said, just a little bit more color.
So we're going to move to our fifth and final core area, the impact of the election on key industries. We're almost into 2025. There's a potential for new policies and regulations from the recent election. There's always that hesitancy before an election once it's decided. Some factors some industries can be in favor, out of favor, depending on who wins and who doesn't win. How do you anticipate changes in the political landscape that'll have an impact on treasury functions in energy, manufacturing, pharmaceuticals, or others? And are there particular financial risks and opportunities that treasurers need to be preparing about for, later January and beyond? And so we'll start with Dory, and we'll close out with Yusuf on this one.
Right. Yeah, so I don't think anybody can really say for certain, right? The economists are just like the weatherman. They can be wrong without being impacted from a job perspective. But what is interesting is I hail from Detroit. Okay, so go Lions for those who are fans out there. But we are a manufacturing hub, and there's a lot of trade happening between us and Canada, and of course Mexico, when it comes to that manufacturing hub. And when the threat came out of the tariffs, our manufacturing leaders here in Michigan put out a joint statement that it would impact or increase the cost per car by $3,000. Now, that's just based off of management by X or tweet, however you want to phrase that. That is 25%. That's $3,000 per car. So whether that goes into effect or not, how it's going to impact manufacturers or not, there's a lot of uncertainties, and that's that's what you want to look at, is how do you manage those? How do you position those? And we talked about all those things on this webinar, looking at your working capital, looking at your cash conversion, making sure you have the right visibility, making sure you have the right tools so you can help, mitigate that bluntness of your costs going up overnight when it comes to those certain areas. So there's a lot of uncertainty. Nobody can say for sure what's going to happen, but it doesn't seem like it's going to go away anytime soon, in particular when you have wars outside of just here domestically in the US. Pretty much every continent has some sort of a war going on in it right now, right? Other than here in the US, whether it's in Africa or the Middle East or in Europe, there's a war going on somewhere. And those things tend to have a lot of volatility that comes with them and a lot of impact that has to come with them. And historically, we worried about counterparty risk when it comes to bank relationships. You may have to worry about in 2025 counterparty risk as to where you're regionally, where you're doing business, and making sure that you're able to extract what you can out of that region and maintain resiliency when it's uncertain. Now, that's very, very far-fetched if you have to get there, but a couple of years ago, you had to figure out what to do in Russia, right? As it became sanctioned. So there's a lot going on, and you just have to be on top of it and be mindful and have data at your fingertips, which again requires technology to be able to do that.
Some areas of caution. Yusuf, your thoughts on either the impact on any individual industry or in general?
Yeah, no, I think so. When I sort of heard those discussions, couple of days later, notice there's a lot of discussion around geopolitical hedging, right? How does that look like? We've talked a lot about FX hedging, but how do you hedge if you're in the auto industry where you're getting supplies across the border? So I feel that there's going to be some discussion, additional scenarios, right? It's not just the FX interest rate risk scenario and commodity. It's going to be a disruption in the supply chain finances. There's going to be a lot of volatility, but also discussion in terms of the investment that be made. How do they fare in relation to potential geopolitical scenarios? If we have to produce certain things within a certain region, how does that look like? So I think that it will certainly create volatility, and you also create, I would say, additional scenarios that needs to be analysis in relation to investments and in relation to supply chain and other areas.
Really excellent. Okay, that finishes our 5 key areas. We finished the speed round. Now I'll ask each person if they'd like to share any. Oh, that's right. The third poll question, isn't there? Did I forget the third poll question? I think I did. Can we pull that up? There it is. Thanks for typing that in. Really appreciate it. Regarding possible tariffs of the incoming U.S. administration, my views are that there's substantial posturing taking place to help negotiate better terms. One major goal is to onshore more work to the U.S. Tariffs will increase. I'm not going to read them all. I'll just let you fill those out. That'd be just great to see where everything is. And we had enough responses, quite a few over the 200 we asked for. Thank you for your engagement on the poll and for filling out in the chat. I'll ask Brian to put up LinkedIn connections so you can follow Kyriba and you can follow Strategic Treasurer on LinkedIn. That would be great. Our marketing teams like that. Makes them happy, and if they're happy, we're happy, and that's one of the best ways of thanking us. So we have enough in there. No need to type Kyriba 25 another 100 times in there. We saw the energy, which is great. All right, so we'll see the tariffs. And so for wrapping up, why don't we go Dory, Andrew, and Yusuf, if we could do that for final thoughts. So go ahead and Dory, any final thoughts?
I'm going to give final thoughts on this tariff question here. I love how 26% said that they see that as the ultimate goal is to do more onshoring. Again, hailing from Detroit, the manufacturers talking about that. It takes about 4 years to stand up an automotive manufacturing plant in the US. So the goal may be to onshore, but those things don't happen overnight. So those costs are going to be there for quite some time if they are actually enacted. And by the way, our cost of labor is very different than it is in Mexico. So there's another impact there when it comes to inflation. So some things to think about. It's great that we want to onshore. We all love made in the USA, but there's some things to think about on how that's managed.
Excellent. Thanks. Okay, so Andrew.
Yeah, I guess just to close, a lot of the topics were around AI, APIs, kind of the technology side. I think Dory kind of summed up something that I think is important when we finished the previous section about embracing, kind of be willing to embrace the new technology that's out there, but it still does need that level of human kind of intervention to be able to deliver the finished product a lot of times. And so I think again, just the best kind of combination of, where we'll go, not just from a treasury perspective, but, to kind of embrace and hone in on all of the capabilities that are out there, and not intentionally shy away.
And Yusuf.
Yeah, no, I would say I think these are exciting time to be in our space. I remember when the internet came out with the dial-up, and then you do the cable, and then you went over to fiber. I feel that what's coming out now in terms of AI, we're really starting off with the optic fiber. So it's really a great time. These models can help us a lot, and we have really been treated with some very, very capable solution from day one. We don't have to go through the dial-up, the cable, and so on. We're starting off really at high speed here. So I would say embrace it. This is the future. This is where things are going, and get excited about it because, again, it can really help us here, as we just discussed.
Excellent. Thank you each so much. Great input. Very, very fun to listen and learn what you're saying, where things are going. Thanks everyone also for jumping on this webinar, the panel discussion on 2025 Treasury trends. So again, thank you, Dory, Yusuf, and Andrew. And I'll turn it back over to Brian.
Well, thank you everyone for joining us today. The CTP and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on succeeding in 2025, be sure to check out the Treasury Update podcast by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.